Hello, value investors. Welcome. Thank you for joining me. I want to talk about value investing, why it matters, and some investment mistakes. So let's get started. It's important to be humble when you invest, and it's important to understand that a lot of theory is pretty much worthless compared to a tiny bit of practice. You just keep following companies, you keep doing the hard work of thinking through the business models, and you are going to do much better over time than just somebody that kind of understands theory. So I believe that, nothing beats you kind of splitting, let's say, like $1,000 into, let's say, increments of 100 into 10 different companies and following those companies over let's say 6 months. You're going to learn a lot. Even if you haven't got a lot of capital, you compound your knowledge over time. So I also believe, though, that you can spend a lot of time researching companies and you're just going to be ended up looking for confirmatory biases. So you're going to look into things that align with your hypothesis of why the company is a super business. So you have to kind of balance it off. You have to be willing to learn a little bit about many different companies and business models, as Charlie Munger talks about, having different mental models. So you have to kind of be able to do the hard work of learning about many different mental models, but you also have to be humble enough to say, hey, there are things I'm not going to know about this company. Even like, let's say, the most followed company in the world, like Apple, you're going to look at Apple today and you're going to think, oh, it's kind of fairly priced. And then you're going to look and, let's say, in a year's time, and the share price will be totally different. And it's like one of the most followed companies with an army of analysts globally following it, and it's still mispriced. You got to be humble enough to say, okay, I don't have all the facts. And I believe that the one way to get around that is to demand a large margin of safety. And another way is to diversify into more, let's say, five, six, seven positions. I think that can be quite helpful. Um, the world is very unpredictable, and you have to take that in mind. So you have to be willing to prepare your portfolio for the unpredictable. Black swans come out, and when they do, everything seems to hit the fan at the worst possible time. And your portfolio will be down just as much as everyone else's. The only difference is that as a value investor, the idea is that you've been very prudent and you've bought reasonable business with strong free cash flow, and that when the market starts to kind of stabilize and the news flow starts to be a bit less bad than the day before, your portfolio should start to increase substantially quicker than the rest of the market. And many businesses that were overpriced before, they're not back to former glory. So that's something that should keep in mind. And finally, I believe that it's important not to try and time the absolute bottom of a company, the cheapest price, but to just generally buy low, understand that they may well continue to sell off over the next 3, 4 months, but think that, okay, the next 3, 5 years, this business is going to be more expensive than it is right now. So it's better to be kind of on the general trend of where the business could be in 3, 5 years than trying to be inundated in research and be very accurate but be ultimately wrong. So what Howard Marks talks about is, as a value investor, you're just really hitting, like it's like amateur tennis. You're just hitting that ball over to the other side of the net. You're not trying to go for the ace every time. You're just really trying to just bat that ball back to your opponent. So it's just kind of understanding a vague trend of where a business could be. And yeah, that's pretty much it. Thank you so much for watching. Bye bye.